Hi, I'm Ryan, the Frugal Analyst, and every year before I file my tax, I always try to max out my IRA contribution, and I'm going to tell you why in this video. Now, I'm not the only one doing this. Rich folks like Peter Thiel turned his IRA into a $5 billion tax-free investment vehicle. The wealthy are using IRA as much as they can, and the IRS purposely limit on how much you can contribute each year. I personally have over $700,000 in IRAs as of this video. So why contribute to an IRA? The main answer is to reduce taxes. In a typical investment account without an IRA, you receive an income, then you get taxed. You put the money in an investment account to grow, and every time you made realized gains, it gets taxed again. IRA are special accounts that allow you to shield taxes. There are traditional and Roth IRA, but basically you only get taxed once. In a traditional IRA, you make an income, then you can invest that money pre-tax, let it grow, and then get taxed once when you pull the money out in retirement. For Roth IRA, you pay the tax first, and the investment gains are free afterward. In both cases, there's only one taxation event, and that's the key in keeping more of your gains. At a minimum, you can save the capital gains tax. For example, a single person with no deduction is making $100,000 per year. The federal tax bracket is 24% for gross income earned after $86,000. The person wants to invest $5,000 in an index fund, and the fund doubled in 20 years. In a regular investment account, the user sets aside $6,600 in gross income. It gets taxed at 24% and ultimately have $5,000 to put into the investment account. The investment doubled to $10,000 and he or she gained $5,000. The tax is the favorable long-term capital gains tax at 15% that costs $750. The investment account ends at $9,250. In a traditional IRA, the user puts in the same $6,600 in gross income to the same index fund that doubled to $13,200. At retirement, if the tax rate is the same at the 24% bucket, the tax would be $13,200 times 24%, or roughly $10,000 net value after tax. In a Roth IRA, the user is putting post-tax money, so $6,600 minus tax equal $5,000 investment, and it grew to $10,000, and there's no additional tax here. The tax is already paid, so the remaining is still $10,000. Ultimately, the IRA gives the user more money because of less taxes. If the user receives dividends or buy and sell investments more often, then the tax cost increases. If I could, I want all my investment invested through an IRA. Now, there are exceptions to avoid IRA. If you have debts bearing 5% interest or higher, like a credit card, it is better to pay off debt than invest in an IRA. An IRA do have penalty when withdrawing before the age of 60 and restriction on what you can invest in. So if you need cash in the short to medium term, like buying a home, invest in yourself or a business, it is difficult to use the money in an IRA without incurring withdrawal penalties. There are exceptions to avoid penalties, like buying a first home, qualified education expense, withdrawing a Roth IRA's principal contributions, among other exceptions. But overall, if you know you need the money in hand, it's simpler to keep it out of an IRA. So please consider maxing out your IRA every year. I always do mine before I file my tax to calculate the exact number I can contribute. Typically, the tax software will tell you how much you can contribute, or check the government website on your contribution limits. So thanks for watching. I make videos around personal finance and saving money. Subscribe for more and stay frugal.